For the 2018 tax law year, the United States Congress has passed some significant tax law changes. Will your family benefit from the new law, or will you end up paying more in taxes? I'll compare the 2017 and 2018 laws for different income groups, coming up next. For 2018, Congress has passed one of the most sweeping federal income tax changes in decades. While there are tons of changes in the law, I wanted to look at the impact on the average American family. You know, the standard married filing jointly with 2 kids. The law brings about major changes to 4 aspects of income taxes that affect most families: tax brackets, personal exemptions, deductions, and tax credits. In 2017, federal income tax brackets ranged from a low of 10% through 39.6%, 7 brackets in all. 2018 keeps 7 brackets, but they are slightly lower, ranging from 10% through 37% at the high end. You can see that all but 2 of the brackets have been lowered. The income threshold to break into each bracket has also been adjusted. In 2018, you need to make a lot more to break into those higher brackets. Now let's compare the 2 laws side by side so you can really see the difference. Pick any income level and you can see that for 2018, your family will be in a lower tax bracket. For example, a family making $40,000 used to be in the 15% bracket. Now they're only in the 12% bracket. At $100,000, you drop from 25% down to a 22% tax bracket. Changes to the income threshold could also mean a difference in the tax bracket level. For example, a family making $250,000 in 2017 was in the 5th highest tax bracket at 33%. But for 2018, they're only in the 4th highest bracket of 24%. For 2017, every person on a tax return received an exemption of $4,050, which reduced the family's taxable income. A couple making $50,000 a year would receive 2 exemptions, reducing their income taxes by $8,100. Add in 2 children, and that deduction increases to $16,200. For 2018, though, there are no personal exemptions. For families with children, tax credits have been increased to compensate. We'll look at that a little bit later. Deductions reduce your taxable income when you spend money on things like medical expenses, a mortgage, or you give to charity. In 2017, you also received a standard deduction of $12,700. The individual deductions only helped when the total exceeded the standard. For 2018, we still have a standard deduction, but it is almost doubled to $24,000. The new law makes the first $24,000 in earnings completely tax-free. Exemptions and deductions reduce your taxable income. Tax credits reduce your tax liability. Here's the difference. If your family's taxable income after deductions was $19,000, you're in the 10% bracket. An additional $1,000 tax deduction will reduce your taxable income to $18,000, saving you $100 in taxes. A $1,000 tax credit, though, will reduce your tax liability directly, saving you a full $1,000. There are several tax credits available to families, but for 2018, the one that has changed the most is the child tax credit. In 2017, a family received a $1,000 tax credit for every child under 17, as long as your income was under $110,000. For 2018, the credit has been doubled to $2,000, with the income limit rising all the way to $400,000. Lower tax brackets, changes to the way exemptions and deductions work, and changes to the child tax credit all spell confusion. So let's run some numbers to see the effect on families at different income levels. Here's how the calculation works for a married couple with 2 children who made $50,000 in 2017. With total exemptions of $16,200 and a standard deduction of $12,700, tax liability is $2,233. But 2 children also qualifies them for $2,000 in child tax credit. So net tax liability is only $233 for an effective tax rate of only 0.5%. For 2018, the calculation looks like this. While there's no exemption, the standard deduction is $24,000, leading to a tax liability of $2,739. But the child tax credit now equals $4,000, making the net tax a negative $1,261. Since the negative tax is a result of a child credit, not only will this family pay no tax for 2018, they'll actually receive a check for $1,261 in the form of a refundable credit. I'll just set the tax rate at 0%. Now for a couple making $100,000. Net tax liability is $7,733 for 2017 for an effective tax rate of 7.73%. For 2018, the net tax is $4,739 or 4.74% of income. That's a 39% reduction in tax from 2017 to 2018. Let's do one more at $300,000 in income. In 2017, tax liability is $64,680, and because this couple's income is over $110,000, they lose all of their child tax credit. This puts them at an effective tax rate of 21.56%. The same couple in 2018 will still get their child tax credits and end up with a net tax of $50,819 or 16.94%. That's a 21% reduction. In fact, in every bracket I tested, I found a reduced tax liability in 2018, with lower income families seeing the greater savings. But since the child tax credit is such a big part of the calculation, I ran the same income levels for a couple with no dependents. As you can see, they also pay less taxes in 2018, no matter the income level. You can get a printable version of the charts within this video and learn more about the 2018 tax law change by clicking on the link to my blog below.